Hello, guys, and welcome to another video here on my channel. Today we're discussing the bias, how I determine the bias for the New York AM session every single day. And we will go more specifically into one aspect I'm looking into every single day. For those who always join my pre-market analysis live streams, know what I'm talking about. I'm talking about the 20 minutes time frame bias. But I'm also going to show you my checklist, how I determine the bias with multiple factors. And I have a checklist where I go through all of the points and see if they are telling me that we're either more on the bullish side or more on the bearish side. So let's start. First of all, I'm always starting on the higher time frames, and not only on NQ, on NASDAQ, but also on ES and YM. So I'm comparing all of the three indices because they are correlated markets, and I want to see if we have a cracking correlation between those markets or if they move in sync. But yeah, let's start with the first point I'm looking at every single day. So I'm giving you my whole checklist here. And the first thing I'm looking at is where did we open up using previous days range. So where did we open up using previous days range? So this is the first factor I'm looking at, and it's pretty simple. What I'm doing on the chart is, let's say, for example, in this case, yesterday, if we have the day before, so in this case, Thursday, then I will take the Fib retracement tool and measure the previous day's range. So in this case, Thursday. And what I'm looking here is where did we open up this day in this range. So in this case, we opened up in the upper quadrant of previous day's range. And that in itself normally is a bullish signature for me, but I'm only taking this into consideration if we didn't take out previous day's high or previous day's low. So in this case, I know, because I saw it yesterday, that that was not the case. Like, yes, we opened up in the upper quadrant of the previous day's range, but yesterday we already took out previous day's low before we opened up at 9:30. So this wouldn't be a significant factor for me anymore to look at. So it would be only significant for me if we didn't take out previous day's high or previous day's low. So let's say we didn't take out previous day's high or previous day's low, and we opened up in the upper quadrant of previous day's range, then I would consider that as a bullish signature, and I would look for us to sweep previous day's high. So let's go to the second signature I'm looking at to determine the bias. second. Did we take out previous day's high, previous day's low on all the indices? So, and to add to the first point also, I'm doing that on all the indices. So not only on NQ, but also on ES and YM. And you can also see there a cracking correlation. Normally, we should see the same opening of the previous day's range if the indices move in sync. But if you see there a cracking correlation, let's say in this case, NQ opened up in the upper quadrant of previous day's range, ES also, but YM did open up in the lower half of previous day's range, then you can see, okay, one of the indices is doing something completely different, and that could be the first warning sign for you to see if this one indice that is not doing the exact same thing as the other two indices is either the one that is doing the manipulation or the one that is leading the market and telling the truth. So then I look at, did we take out previous day's high or previous day's low on all the indices? You can see there as well if we have a crack in correlation. So let's say NQ didn't take out previous day's high or previous day's low. ES as well, but YM already took out previous day's low, let's say, for example. Well, if we are overall in a bearish trend like we are right now, that could signature to you that ES and YM are also seeking to go to the previous day's low and take out that. So one of them is either signaturing that we're going to catch up with the other two indices as well, or it can also signature to you that this is an SMT. And let's actually go to ES and YM so that I can show you an example. So we are on NQ, ES, and YM on the one on the daily time frame, and let's see if we have a example for that. So yes, we have one example here. You can see this is the high of Friday on NQ. This is the high of Friday on ES. And this is the high of Friday on YM. So let's imagine we have Wednesday. So this day right here. And we see when we open up the charts and look to determine the bias, how the daily chart looks like and what the previous day took out, what highs on the daily time frame the previous day took out. And in this case, we see we have a cracking correlation with ES on NQ and YM. You can see that NQ took out the Monday high on Tuesday and also the Friday high on Tuesday. And YM did exactly the same thing. On Tuesday, it took out Monday's high and Friday's high. But we see that ES couldn't do that. So ES couldn't take out Friday's high on Tuesday. So that would be a signature for me to have a continuation to the downside, because that is an SMT on the higher time frames. So let's get back to NQ. And also a good example for me from yesterday. Yesterday when we opened up at 9:30, or even before that, when we go to the 1 hour time frame, we can see that better. We can see here, as soon as I did my analysis, which I normally start doing around 8 a.m. or 7:30, I saw exactly this. This is the low from Thursday. So this is the previous day's low. And I saw that we already took it out. But what I saw instantly was that we barely went below it. So when we see liquidity taken out just a little bit, then it is very likely that we're going to take it out another time and then have a reversal to the other side. So in this case, we are clearly bearish, so that would not be the case. But also, in general, if you see one side, like the previous day's high or the previous day's low, already taken out, that could signature to you as well that we are done at that key level and that we're going to reverse to the other side. And it is especially telling if, let's say, we have this candle here not forming a wick below the previous day's low. So let's say, for example, we see us close below that, let's say on the 1 hour time frame, and right the next candle, the next hourly candle, closes above again. So that would signature to me that we're very likely to not drop lower again. So always keep that in mind. So the third thing I always look at is how many handles did we already move. Okay, so here we have again the perfect example was yesterday. As I was telling you in my pre-market analysis live stream, I will always take the measuring stick, and when I'm doing the analysis, I measure the move we already made on the day. So let's say on Thursday, when we are doing the analysis, we could have seen that it is 300 handles for now. Let's actually go to the 30-minute time frame because we can see the opening there better. The opening was at 9:30, so before we opened up, we moved 324 handles so far. So that is not too big of a move. When we compare it, for example, to the daily move we had on Wednesday. Like on Wednesday, we had a move of 645 handles. So yesterday, I was telling you in the pre-market analysis that after every daily range where we didn't move that much, the likelihood for us to have a bigger range the next day is very likely. And this is the perfect example for that. Let's say everything below 400 handles is a not too big of a range for a day in this price action that we have right now. Like when you compare it to, let's say, 2 years ago, then that is completely different because we didn't have that much volume overall in the markets that we do have right now. But if you compare the days here, the ranges we have, then you can see that 300 to 400 handles are relatively small for a daily range. So here we have on Thursday 398 handles. And what we did on Friday, we moved 689 handles. So that is kind of a big range. And it is always the same thing. When you look at, let's say, Tuesday, you can see that we had 388 handles on the day. So I can say that this is not too big of a range we had. So it is likely that the next day will expand much more. And this is what we did the next day. And what is even more higher probability is if the previous 2 days had a relative small range, like we see right here. Yeah, that's not relative small, but you see where I'm going. So always consider that. Then let's move on to the next point, because the most important point is going to be the point, something I'm going to mention later on in the live stream, the 20-minute bias, like I told you. So I'm going relative quickly over these points so that I can go more in depth on the 20-minute bias. So the fourth point I'm looking at is, where are we currently from this day's range? So this is also pretty simple. So when you go to the 1 hour time frame, and let's say let's take for example this day, Tuesday. So we opened up at, no, let's go to the 30-minute time frame. So we opened up at 9:30, and you can see when you measure the move that we had before 9:30 then we can see the quadrant levels of the range we already made before we had 930. And you can write that in your notes that it is very likely that if we are above the whole range we formed throughout the day from starting at the daily open from 6 p.m. to 9 a.m. before we opened up right at 9:30, it is very likely for us to see shorts. So it is a higher probability to take shorts rather than to take longs. But as soon as we drop again inside of that daily range that we formed before we opened up at 9:30, then you can look for longs again, like we had perfectly in this case. So we went higher, then we could have taken shorts above the daily range and then take longs as soon as we get inside of the daily range. What's even more probability, like what's even higher probability is if we are below the whole daily range and from there to take longs again. But what you also have to consider is if we are in a trending market on the higher time frames. Like you can see here on this day, right now, we are very heavy. We have a very heavy price action. And when we look at the daily range we formed before we opened up at 9:30, we can see here, this is the range we formed before we opened up at 9:30. We see that we barely could tap into that area again. But you see, as soon as we tapped into that area again, the range we formed before 9:30, this is where high probability setups could have formed for you to take shorts again. And also a signature for you is that if we already displaced below, as you can see here, on a higher time frame, let's say like the 30-minute time frame that we have right here, or if we go on the 1 hour time frame, this is also a good time frame to consider, or the 4 hour time frame as well. But let's stay at the 1 hour time frame. When you see that 9 a.m. displaced below this daily range that we formed, and the next candle, 10 a.m., was not able to displace to the upside again, then it is very likely for us to drop lower and that we can short above this daily range, like inside of the daily range that we formed before we opened up at 9:30. So this is one thing I'm considering every single day. So then let's get back to the next point, to point number 5. So point number 5 from my checklist is do we have a SMT, daily or higher time frames? So I kind of touched on that briefly when I was showing you and explaining you point number 2, like I've outlined right here, the SMT we had with ES and YM on the daily time frame. So this is something I consider, and not only on the daily time frame, but overall on the higher time frames. So we could also have session SMTs, for example. Let's say that NQ already took out London session high, but ES didn't, and YM also didn't. That could be a session SMT at the highs, and that could signal to us that we see further continuation to the downside, and that NQ just did a manipulation to the upside, and the other two indices are in sync with each other, and they're basically showing the truth and yeah, like showing you that we are going to have continuation to the downside. And then the next thing I'm looking at is the new week opening. So point 6, are we above or below new week opening? And this is also a thing I'm considering on all the indices, so NQ, ES, and YM. And let's go to the 1 hour time frame. And actually, let's open up the other indices as well on the 1 hour time frame. So, as you can see here, this is previous week, and we opened up at 6 p.m. on Sunday. This is the weekly open, so the new week opening. And I'm always having this area on my chart in red. Let's do that on ES and YM as well. So ES and YM. Okay. So yesterday we had the perfect example for that, and on Thursday as well. That is amazing. So what I'm always considering here is the 1 hour time frame and the 30-minute time frame. One thing I consider is, are we above or below the new week opening? So whenever we are below the new week opening, then it is good for longs, and whenever we are above the new week opening, then it's good for shorts. And especially what I look at is how we react at the new week opening. So when we see the 1 hour time frame, it looks a little bit different than the 30-minute time frame. So we can see in this instance better what I mean on the 1 hour time frame. So whenever we see on the 1 hour time frame or on the 30-minute time frame, so either one of those two, that we are right at the new week opening. If we see an hourly candle displace below, and the next hourly candle displaces again above the new week opening, then it is a warning signal for you that this low is going to hold for the day. That this is signaling that we will not continue to the downside on this day. So in this case, we didn't, and we held this low right here, and we could have looked for long setups inside of this wick down here, because this low should hold. But if we see on the other hand, the example we had yesterday, that yes, we first got support at the new week opening, but after that, we displaced below it. And as soon as we see this displacement below, but the next candle did not displace above it again, like we saw right here, then it is signaling to you that we will continue to the downside and that we will see, or that we should see, resistance at the new week opening, which we did right here in this case. So the same is of course true for the other way around as well, so for longs. And what you can look at here is the correlation of these markets as well. As you can see, this week YM was the weakest, and we saw a displacement below the new week opening on Wednesday, and ES and NQ did not go to the new week opening on Wednesday, but later on in the week. So yes, also always look at these signatures, not only on NQ but also on ES and YM, and if they're all signaling the same thing to you, then that's a good probability, like high probability for us to have a low resistance liquidity run in one direction. Like we had here, we already displaced to the downside on YM, but NQ and ES kind of stayed in that area of the new week opening. But as soon as we saw on Friday that we finally got the displacement to the downside on NQ and ES, then you can say that, okay, now there's nothing in the way for us to continue to the downside. Like you can see here, for example, on Thursday, we would have seen on ES and YM, okay, we already displaced to the downside and we didn't displace again to the upside on the next candle. Like we can see here, we displaced to the downside and the next candle did not displace to the upside, and YM also already displaced to the downside. But then we can see that NQ did displace to the upside again, and that was a signature for you to say, okay, this day might not go lower. Then let's again go to the next point. And the next point is what I just outlined, but I'm going to write it down so you can have it on your checklist as well. The point 7 is how did we respond to the new week opening on the 30-minute or 1 hour time frame so far? On all indices. So let's get to point number 8. And now we're getting to the interesting part. Something I haven't mentioned in any live stream so far. And now I'm going to tell you my little secret in point 8 and point 9. So, do we have an IPTA PD array on the 1 hour time frame? And so the next point number 9, is going to also mention IPTA. And this is what I'm always mentioning on the 20-minute time frame. And what I want to point out clearly here is that this is not completely my concept. This is not completely my idea. Yes, the 20-minute time frame, and to determine the bias based on that idea is my model. But I got introduced to that by, first of all, yes, ICT, to IPTA overall, but I got introduced to that from Frank369. So if you want to learn more about that concept, check him out. He's called Frank369 on YouTube. So the logic behind 369 is what I mean with IPTA. So the logic behind 369 is timing in the market. So whenever we have a time that adds up either to 3, 6, or 9, that is an IPTA time. So let's say, for example, 9:30. If you look at 30, it adds up to 3. But if you look at 9:32, if you count 2 and 3 together, it is 5. So this is not an IPTA time, for example. But you can also count the hour and the minutes, and then you can get IPTA times as well. So I'm not going to go much in depth on that concept because, like I said, let's continue this here, and you can check out Frank's videos if you want to learn more about that. And this is the signature of institutional money and how the markets kind of work. But you can go down the rabbit hole on that one if you want to. I did the last few months, the last 5 to 6 months, and it is crazy. But yeah, let's actually look at the 1 hour time frame. So to give you a little bit of a more practical perspective on what I just explained, is I look for PD arrays and especially for FVGs on the 1 hour time frame which formed at IPTA times. So an example would be yesterday. When I was looking at the market yesterday, I was looking at this fair value gap, like you saw me outlining in the pre-market analysis. So, and to give you a little bit of more examples, I'm going to go back this whole week and show you the IPTA times where we formed PD arrays, especially for value gaps. So as you can see right here, when you open up the chart, let's say at 8 a.m. before we opened up at 9, then you can go back and look at all the fair value gaps and see if they formed at an IPTA time. So 5 o'clock is not an IPTA time because it doesn't add up to 3, 6, or 9. Then the next fair value gap we have is this fair value gap here at 3 p.m. This adds up to 6. So 1 and 5 equals 6. So this is an IPTA FVG. So the market, after we displaced below that, should go back into this fair value gap to have resistance, which we did to the tick right here. When we go back further, so that I can give you a little bit of different examples as well. This is not an IPTA fair value gap. This is also not an IPTA fair value gap. This right here is an IPTA fair value gap because it is 24, because midnight is not only 0, 0, 0, 0, but also 24, like 12 p.m. No, 12 a.m. So it doesn't matter if you say 24 or 12 p.m. It adds up to 3 or 6. So that would be an IPTA FVG. And this is where we get resistance. You always have to look at the bodies and the wicks, and you see that we closed all of the bodies below that IPTA FVG, and we only wicked into it or even a little bit of above it. And you can see here on Thursday you would have had a pretty nice key level to take shorts from, and also at the Asia session on Friday to take shorts from. So let's look at other examples. This right here is also an IPTA fair value gap. IPTA FVG. Here, to the tick, we wicked into it and then rejected it. Here we closed into it, but the next candle closed below it. So if you look on a higher time frame, so let's say you look on the 2-hour time frame, that would only be a wick inside and the body closed below it. So you always have to consider other time frames as well. So whenever you see on a lower time frame, or not a lower time frame, but a time frame that shows you this signature right here, if we close above a certain key level and the next candle closes below it, then this is a wick on the higher time frames, and it is showing you that still it gives us resistance here. And also always consider the quadrant levels. If you can see here, this is the midpoint of this FVG, so we shouldn't, if we respected this FVG, close bodies above the midpoint of the FVG. So as soon as we see that we close inside of that FVG but still below the midpoint, then that is fine. And the wicks, they are allowed to wick above the midpoint. So another example I know would be this little FVG. This is also an IPTA FVG. As you can see here, this is 6 p.m. and we had beautiful resistance to the tick right here. If you have a look at that IPTA FVG, the high of that IPTA FVG is, let's have the eyes above here. It is 24,616 and 75. And here the high is 24,616 and 25. So that is pretty much to the tick. But also always consider the IPTA FVGs we have above. So as soon as you see this candle right here close into that IPTA FVG, you need to look at the IPTA FVGs we have above. So, and this you can do not only with FVGs, but also with other key levels. So you can do that with rejection blocks, you can do that with order blocks, you can do that with every PD array in the market. So let's delete this. I'm going to show you other examples as well. So you can see right here, this is the 9 a.m. candle. And when you consider the fact that we discussed in the point before that we see this reaction here at the new week opening, then you could say, okay, this should be a low right here that can hold. Not only the fact that we displaced below it and then at the next candle displaced above the new week opening, but also because this is an IPTA time, 9 a.m. So based on these two things, you could say, okay, this candle right here, this wick right here could act as support to look for longs. So you can take the fib retracement and measure this wick. This is a rejection block, and you should see the bodies stay above this rejection block and only the wicks go inside of that rejection block, and we shouldn't go below especially the bodies shouldn't close below the midpoint of this rejection block. So here perfectly, as always, the midpoint, this is the most sensitive level of any PD array, not the quadrant levels. These are also important, but the most important one is the midpoint, and from there you could have had a beautiful point of interest on the lower time frames to look for longs on Thursday. Another example would be an order block. Let's say this one right here. This is formed at 3 a.m. So also an IPTA time, because it adds up to 3, 6, or 9, because it is at 3 a.m. and you can do that on every time frame. So not only on the 1 hour time frame, but also on the 1 minute time frame, the seconds time frame, whatever, the 5 minute time frame. Yes, so you can see here we also respected this level right here for continuation to the downside on Friday. This is an order block, or you can also only take the body of the order block. So right here, the open of this order block is, if you look up here, is 24,527.75, and the high is 24,527.5. So you can see, oh, it was 1 tick away. So that is also a signature for you that we were very weak. Like 1 tick away from that key level, it is showing very heavy price action, but overall this whole candle is an order block. So let's continue with the next point, and we will go more in depth on that point. So point number 9, this is what you have all been waiting for, what I've been teasing in my pre-market live streams. So 20-minute bias. Yeah. So now I've introduced you to the logic of IPTA, and this is what we will apply on the 20-minute time frame. So let's go to the 20-minute time frame. So you have seen this chart if you are joining my live streams on a regular basis. And I'm always starting after 7 a.m. to make my daily bias, to determine my daily bias. So what I'm always doing is I will draw a vertical line at 7 a.m. like you can see here, these gray lines. So what I'm looking now is I'm looking at every high or low that formed at an IPTA time. So as you can see here, the red lines are the lows that formed at an IPTA time, and the green lines are the highs that formed at an IPTA time. So for example, when I was determining the bias for Friday, you can see that right at 6 p.m. we opened up the day. And I'm going back from 7 a.m. and I will have a look if we displaced the IPTA highs or lows either to the downside, so the lows to the downside and the highs to the upside. So we can see here 3 a.m. This is an IPTA time and we displaced it to the downside, very important, before 7 a.m. So everything we did before 7 a.m. is important because right at 7 a.m. we start the New York AM session. So from 6 p.m. until 2:30 a.m. is the Asia session. Then from 2:30 until 7 a.m. is the London session. And then from 7 until 11:30 is the New York AM session. So everything before 7 a.m. So what I want to see is if we get 2 displacements back to back from IPTA lows to the downside. And if that is the case, then I'm bearish. And this is the perfect example we have right here. This is an IPTA low, we have a displacement to the downside. So the next IPTA low is this low right here. It is 6 p.m. So 1 plus 8 is 9. It is an IPTA low. So we see right here, we have a displacement to the downside. So 2 displacements to the downside, and that means we will have a bearish session. And this low, the latest IPTA low we displaced to the downside, is also a key level to look at, to have this right here as a key level to look for shorts. Not only because this is an IPTA low, but also, no, this is a different thing that I was explaining. No, this is good. But as you can see right here, that it would have been only a key level before 9:30, or I think this is also after 9:30. Yeah, but sometimes that is also the case that we can't even come back up anymore to that level to take shorts, but we just go to the downside from there on. So as you can see right here, these are the IPTA highs. So this is 12, like this is midnight. This is 6 p.m. So also an IPTA high, and this is 4:20. So if you count it, 1 plus 6 is 7, 7 plus 2 is 9. So it adds up to 3, 6, or 9. So we can see here we had a displacement to the upside at this high. But after that, we did not displace this high to the upside and also didn't displace this high to the upside. So that means for me that we are very weak. But let's say that this displacement to the upside would have been between this displacement to the downside and the second displacement to the downside. Then that would be the case for me to say, okay, this is a red flag that we might not see continuation to the downside. So important, we need to see 2 displacements to the downside back to back without a displacement to the upside in between. So I will give you now more examples on that, and I will actually go to Tradezella for that. So let me quickly change the chart to Tradezella so that we can see on the old contract what we did there. So now it is normal that you don't see anything. Okay, now you should see Tradezella. All right. And we will have a look at examples from let's start at the beginning of March. So we will go through a few examples. Let's say we will go through 1 week of price action. So we are on the 20-minute time frame. Important. First thing we always do. So let's start here on the 2nd of March. When we open up the charts and do our analysis, we draw a vertical line at 7 a.m. And guys, you can backtest this even further to the back and also forward-test it. And let me tell you, it has a very high accuracy. Like if I had to guess from the past examples, from the past, let's say 2 months, it has an accuracy of 90%. So that is pretty awesome. So let's have a look at the IPTA times, the IPTA highs and IPTA lows. So every IPTA high and IPTA low that gets displaced before 7 a.m. So this is an IPTA low, for example, and it gets displaced to the downside, but not before 7 a.m. because this is at 7 a.m. So this is important to note. So this is an IPTA high 4 plus 2 is 6, and we can draw that here on the chart in green. So I have always the highs that we displaced in green and the lows that we displaced in red. So we have one displacement to the upside, then the next one would be, what would be the next one? Here we have a displacement of this one. This is an IPTA high. Yes, this is only one displacement. So 2 plus 2, this is not, this is an IPTA low, so we will make that in red. So in this case, we have one displacement to the upside, one displacement to the downside, and another displacement to the downside. So what did I tell you before? We need to see 2 displacements after each other, like approximately after each other, for us to determine the bias. But there are things to consider. So first of all, yes, we had a displacement to the downside and another displacement to the downside. So you could say that we have bearish price action at the New York AM session. But after that, we had a displacement to the upside. So this is the first warning sign for you that the bearish bias is not confirmed anymore, because that should not be the case. Another signature for you is that when we have a displacement to the downside, as we can see right here, we shouldn't have a displacement to the upside again afterwards. So as you can see right here, we have a displacement to the downside of the IPTA low, but the next candle is placed above it. So this is also a red flag to consider that the downtrend is not confirmed yet. So you could delete this one. So if you look at that, then afterwards, again, you can see that we only have one displacement to the downside and only one displacement to the upside of an IPTA high and IPTA low. So it is lower probability for you to determine the bias if you only have one displacement to the upside and to the downside. And also you can't consider it that we have 2 displacements to the upside in this case, like this one and this one, because in between we had a displacement to the downside. So what you can consider though is that the latest displacement was to the upside. So it is more probable, like the probabilities are more likely for us to have a bullish bias. And you can see here again, below this displacement, it is a good point of interest to take longs. Let's have a look at another example. And I will not do too many examples, but I will mention it in the next live streams, like every live stream that is going to come in the pre-market analysis, and I will look at these factors in every single live stream so that you have more examples and also more realistic live examples. Like examples where I can't see what will happen next. So, yeah. Let's have a look at the next example. Again, a vertical line at 7 a.m. This is an IPTA high. It is 5 plus 4 equals 9. Then we have, where do we have the IPTA lows? This is not an IPTA low. This is an IPTA low. This is an IPTA low. 2 plus 2 plus 2 equals 6. So here we have, again, an example, a very similar example that we had before as well. So you can see that, yes, we had 2 displacements to the downside before we opened up at 7 a.m. and 1 displacement to the upside. But after you see the 2 displacement to the downside, you shouldn't see a displacement to the upside again. And also here, the latest 2 displacement to the downside are not both relevant because only one of them displays to the downside and the other one displays to the downside, and then the next candle displays to the upside again. So we could delete this one, and then you could see, okay, we only have 1 displacement to the downside, 1 displacement to the upside. The latest displacement was the displacement to the upside of the IPTA high. And again, here, this could be an interesting area, a point of interest area for you to take longs. And this goes on and on. I'm going to maybe look at one more example. Maybe look at a bearish example. Yeah, this should be bearish. Like, I haven't prepared this. I'm just not backtesting, but showing you the real time example. I haven't prepared this, like I said. This is in IPTA low, 6 a.m. We can draw that because we displaced it before 7 a.m. This is not an IPTA low. This is not an IPTA low. This is not an IPTA low. Let's see. Okay. This is an IPTA low. We will draw it out, despite the fact that we only displaced it after 7 a.m. I'm going to explain to you why in a second. This is an IPTA high. Like you see here, 2 plus 3 equals 5. 5 plus 4 equals 9. So as you can see here, we only have one displacement to the downside again. And here on top, we can see that we only wicked above the IPTA high. So this is also very signaling to you that we are very weak. So we can say, okay, the latest displacement we had to the downside is right here. So after you see the second displacement to the downside, even if it is after 7 a.m., then that is even more of a confirmation for you to look for shorts, but again, above the displacement we had before 7 a.m. So as you can see here, this would have been an area to short, and here again, an area to short. So I'm not going to give you more examples. I think this was clear. If it is not as clear as you want it to be, or if you have questions, please ask me in the future live streams in the pre-market analysis. I'm going to go through these examples even more in real time in the future, but now you understand the basics of it, the technique behind it, so that I don't have to explain it in the live streams, in the pre-market analysis. So let's get back to TradingView. All right. So this is the point number 9 I'm considering when I determine the bias. So there are 2 more points I'm considering when I determine the bias. And also one important thing to note is that I'm not giving every single point the same emphasis. So for example, I am not giving where we opened up in the previous day's range the same emphasis as point 9, the 20-minute bias. For example, yesterday, the 20-minute bias told me that we will go short, that we will have a bearish bias, but the first point, where did we open up using previous day's range, would have told me that we are bullish. But considering the fact, first of all, that we already took out previous day's low, would tell me that the first point is not a point to consider at all. And secondly, that it is way more important to consider the 20-minute bias because it is more accurate than the first point. So you have to determine, okay, which one of those are more important, and also if they're all in sync. Like for example, if there is a day where like 50% of those things tell me that we will have a bearish price action in the AM session, but the other 50% tell me that we will have a bullish price action, then I will be very cautious and say, okay, I'm open to longs and shorts, or we could have even a choppy price action, and I will be very cautious of taking any trades, and that I will have to wait for the market to give me more data and give me the reaction on key levels to determine if we are bullish or bearish. So the next thing I am considering is, are we going to gap up or down, and the next point is the unfilled opening range gap. You have heard me say this over and over again in my live streams, the unfilled opening range gaps. I've made a completely separate live stream on that as well. I think it is the latest live stream I did where it says the unfilled opening range gaps and the live backtesting. There we backtested especially the correlation between NQ, ES, and YM of the unfilled opening range gaps. So basically, the unfilled opening range gaps, if we drop lower to a lower time frame, the 15-minute time frame, let's say, and we go to down here, not the electronic trading hours, but the regular trading hours. On the regular trading hours, you see the price action we formed between the open of the New York AM session, the 9:30 open, and between 9:30 and 4 p.m. And what we call these gaps are opening range gaps, as you know. And whenever we don't fill out the opening range gap on the day that it formed, like we had here, for example, on Monday, on Friday we closed at 4 p.m. right here and opened up on Monday right here. So this is an opening range gap. And we didn't fill it in on Monday. So this is an unfilled opening range gap considering for the next days. But I will only take the portion that didn't get filled. So this portion right here. And you can see on Wednesday, we filled it in, but not completely, only to this point right here. So I would have it marked out on Thursday like that. And you can see on Thursday, we filled it in right here. So the remaining unfilled opening range gap got completely filled. And also, as you can see, this opening range gap also got completely filled on the day that we formed it. So as soon as I saw that on Friday, that also gave me confidence to go short because I knew we don't have any more unfilled opening range gaps in close proximity. Like, yes, we have an unfilled opening range gap, for example, up here, still intact, but it is not in close proximity. So that was very, very good for me to be confident in my shorts on Friday. Then, also a factor to consider is not only the unfilled opening range gaps, but overall, are we going to gap down or up? And when we go back to the 15-minute time frames, that is very simple. A gap up is if we close higher than if we open up higher on 9:30 than we closed at the previous day at 4 p.m. So in this case, that would have been a gap higher, a gap up. And for example, in this case or in this case, it would have been a gap lower. So we opened up lower on at 9:30 than we closed at the previous day at 4 p.m. And why I want to consider these facts is that the high and the low and the midpoint of the opening range gaps are key levels to consider to take trades from. So for example, you can see right here that this is an opening range gap. Let's do it like that. And you can see here that everything above the midpoint of the opening range gap would have been beautiful to short. Then also here the key levels on this opening range gap, everything below the high of this opening range gap would have been a beautiful scenario to long. So whenever I see a gap lower, I need to consider us to go higher to at least the low of the opening range gap or even the midpoint of the opening range gap. And whenever we gap higher, then I need to consider for us to go lower to that opening range gap to either get support at the high of the opening range gap, the midpoint, or the low. So that's basically it for the determining of the bias. If you have any questions, then you can ask me in the next live stream on Monday at the pre-market analysis. I hope it was clear for you, and I hope it gives you more confidence in your market analysis, in you determining the bias on NQ and overall in the markets. And I will talk to you again on Monday. And again, I hope it helped you. Please comment down below in this video what helped you the most, or if you have any questions, you can also ask in the comments. I will reply to those. And also, if you haven't subscribed yet to the channel, please leave a follow and leave a thumb up if you liked this video. And I will see you in the next video. Bye!